So the Federal Reserve just cut interest rates for the sixth time, which, by all the traditional rules of economics, means borrowing money should be getting cheaper right now.
Right, that's what the textbooks say.
But it's not. It's like the rules of economic gravity are suddenly operating in reverse. You drop an apple and it falls upward.
I mean, it is the absolute definition of a paradigm shift. Every reliable cause and effect relationship in the market is just being rewritten in real time.
And that is exactly what we are unpacking today. Welcome to the deep dive, everyone. Whether you're managing a portfolio, prepping for a trading session, or just insanely curious about how the hidden gears of the world connect, you are in the right place.
Yeah, we have a really fascinating stack of sources today.
We do. We're looking at massive anomalies in the macro bond market, complete structural shifts in big tech, the reinvention of a 158-year-old lawn care company, and the personal triumph of a legendary TV chef.
Which sounds completely unrelated, I know.
Right. But the connective tissue here is legacy systems being forced to break their old rules to survive.
And the stakes for you, listening right now, are incredibly high. By connecting the dots here, we can understand not just what is changing, but why it matters to your wallet and your trading strategies.
Exactly. So let's start at the very foundation of the global economy, cost of money. The Fed and the bond market are locked in this dynamic that just defies all historical logic.
Yep. To understand any major price action right now, you have to look at the bond market first. And right now, smart money positioning is revealing something deeply unsettling.
Okay, let's unpack this mechanics-wise, because this anomaly is wild. The Fed, now under Chair Kevin Warsh, has been aggressively cutting short-term rates, like 6 cuts, a total of 175 basis points.
Yep, 1.75%.
Right, so long-term interest rates should go down, but the 10-year Treasury yield has actually gone up a full percentage point. From a trading perspective, we're seeing this actionable level hovering in that 4.7 to 5.3% range. Why is the bond market completely ignoring the Fed?
Uh, Basically inflation fears and a total lack of trust. This is actually the only time since we left the gold standard in 1971 that we've seen a sustained rate-cutting campaign paired with rising long-term bond yields.
Wait, since 1971?
Yeah, it's a massive cognitive dissonance.
Yeah.
You have to remember how bond mechanics work. Bond prices and yields move in opposite directions.
Right, so if smart money is selling bonds, the price drops and the yield goes up.
Exactly. And fixed income investors are terrified of losing their purchasing power to sticky inflation. Jim Bianco makes a really brilliant point here. He says, bond traders can stop panicking when the Fed starts panicking.
Oh, wow. That's a great quote.
Right. The bond market sees 65 consecutive months of core inflation sitting above 2%. They look at the Fed cutting rates and think, well, you're just pouring gasoline on an inflationary fire.
So they dump long-term bonds. They're demanding a higher yield to compensate for the inflation they know is coming.
Precisely. And adding to this chaos, the Federal Reserve itself has fundamentally changed how it operates. It used to be this groupthink institution where the chair just dictated forward guidance.
And everyone just fell in line.
Exactly. But under Kevin Warsh, it's acting much more like the Supreme Court. You have 12 independent voters with real ideological differences.
Didn't we just see some dissents recently?
Yeah, 3 members actually dissented and voted to hike rates during this cutting
To
cycle.
hike during a cutting cycle.
I mean, that is the most dissents in a single direction in a decade. So there is no clear reaction function anymore. The market can't predict what the Fed will do next based on the data.
It sounds like the Fed and the bond market are playing a high-stakes game of chicken, but the bond market is driving a tank.
That's a perfect way to put it. And meanwhile, Treasury Secretary Scott Bessent is attempting this modern operation twist maneuver.
Okay, for those of us who aren't bond traders, what exactly is he twisting?
So Operation Twist is when the Treasury tries to manipulate the yield curve. They sell a ton of short-term government debt and use that money to buy long-term government debt.
Okay, got it.
The goal is to artificially drive up the price of long-term bonds, which forces those long-term interest rates down without the Fed having to cut rates further.
Ah, so it's a shell game to keep long-term borrowing costs from exploding.
Yeah, but legendary investor Stanley Druckenmiller strongly criticized this. He argues it's just masking the real geopolitical supply and demand imbalances.
So if the Fed is flying blind and the Treasury is playing shell games, how does the average investor protect themselves from this uncertainty?
You have to recognize that the era of zero interest rate policy is completely over. You can't just blindly buy the dip anymore. The cost of capital is staying high.
And that high cost of capital leads us to this massive collision course. Because right when money is getting incredibly expensive, the government and the private sector are actively competing for capital to fund the biggest infrastructure build-out of our lifetime.
The AI boom.
Exactly, the great capital vacuum. You would think companies would pump the brakes, but they are pouring every expensive dollar into AI, and the numbers are staggering.
NVIDIA's earnings, right?
Yes. NVIDIA just reported blowout earnings, $96.22 billion in revenue, 75% margins, and their new Vera Rubin architecture is in full production.
A monster quarter.
But here is the massive price action anomaly. Their stock price has been moving sideways for months. How can a company print $96 billion and not see its stock surge?
Well, it comes down to physical reality. NVIDIA is completely capacity constrained. Smart money positioning shows that traders know NVIDIA is selling every single chip they can possibly manufacture this year.
And probably next year, too.
Yeah. As a bearish analyst pointed out, it is incredibly hard to surprise Wall Street to the upside when your upside is hard-capped by factory output.
That makes sense. But because the landscape is shifting, NVIDIA's actual competitive moat is shifting too. It's no longer just their CUDA software, right?
Right. For a long time, CDA made it incredibly difficult for developers to switch away from NVIDIA. Now, the moat is TCO, total cost of ownership.
Meaning revenue per megawatt of power.
Exactly. And even wilder, their moat is now their massive $250 billion balance sheet. They are engaging in what critics call circular financing.
Okay, explain that one.
Think of it like a car dealership that doesn't just sell you the car, but also acts as the bank to give you the loan and maybe buys a stake in your taxi business to make sure you succeed.
Wait, really? They're lending money to companies so those companies can buy NVIDIA chips?
Essentially, yes.
No.
It raises some regulatory eyebrows, but it's a financial lever their competitors simply do not have the cash to pull.
Wow. But here's where it gets deeply controversial in our sources. We have this massive AI build-out, but Darius Dale of 42 Macro provides this wildly contrarian take.
Oh, a marketing scheme theory.
Yes. He argues that the entire US-China AI race narrative is largely a fabricated marketing scheme designed to, and I love this phrase, tickle the amygdala of investors.
It's super provocative.
He's saying they are sparking primal national security fears just to justify separating investors from their money to fund this capex.
Right. And to be clear, we're just reporting his analysis here, not taking a political side. But Dale points out that China is already ahead in 66 of 74 critical technologies.
Right.
But he argues they have no intention of using AI to conquer the U.S. He views it as an economic competition, not a physical survival threat.
So he thinks Silicon Valley is playing up the national security angle to keep the funding flowing.
Exactly.
But I have to push back here based on the market. If this is just a marketing scheme, why are the smartest, most profitable companies on Earth buying into it with actual operating profits? I mean, Anthropic and OpenAI are pulling in real net margins. Doesn't that prove there is real economic utility beyond just a narrative?
Well, there is undeniable utility. Dale isn't saying AI is useless. His point is about the macroeconomic risk the scale of this spending creates. He argues the real threat is what he calls Paradigm E.
Okay, Paradigm E. Break that down for us.
He's looking at the domestic political realignment driven by a K-shaped economy.
The K-shape, right.
Yeah, so the top arm of the K is the wealthy capital owners getting richer from asset inflation and AI productivity gains. The bottom arm is wage earners getting crushed by inflation and wealth inequality, along with currency debasement to fund all this.
Man, so navigating this landscape requires completely different visionary leadership, which brings us to a historic changing of the guard at one of the companies driving this future Apple.
Adapting to this era means putting new generals on the field. Tim Cook is stepping down, and John Ternus is taking over as CEO next week.
And Ternus is a totally different profile. Cook is the operations genius who squeezed every ounce of margin out of the iPhone.
Right, the supply chain master.
But Ternus is deeply rooted in hardware and product vision. People are drawing comparisons to Steve Jobs.
The expectations are massive. Wall Street wants the first foldable iPhone, the first touchscreen Mac, and entirely new product categories.
Like treating cameras and earbuds as AI sensors.
Exactly, always processing the world around you. But the most fascinating thing with Apple right now is a total anomaly.
The Mac Mini.
Yes. They didn't explicitly plan this, but the Mac Mini and Mac Studio have accidentally become highly sought-after AI workstations.
It's so funny. It's like finding out your family minivan is secretly an incredible off-road rally car.
That is exactly what it's like. Users realize that if they configured these Macs with 32 gigabytes of unified memory, they could run advanced AI agentic workflows entirely locally.
And we should clarify, agentic workflows mean the AI doesn't just answer a question, it actively completes multi-step tasks for you.
Right, which normally requires a massive cloud server farm. But Apple's unified memory lets a desktop Mac hold an entire massive AI model right there on your desk, bypassing the cloud entirely.
Which brings up a huge question. With privacy being such a hurdle for AI, does this shift to local processing give Apple the ultimate upper hand against competitors like Meta?
It absolutely could. Meta has struggled with smart glasses. For this exact reason, consumers do not want their audio and video harvested in the cloud. By running AI locally, Apple solves the privacy issue natively.
Finding an unexpected backdoor to the consumer isn't just a tech thing, though. This brings us to our final theme. Surviving a paradigm shift often means using what Andrew Zimmern calls a Trojan horse.
This is such a great connection. Knowing what the market will accept and using that to sneak in your actual mission.
Let's look at Zimmern's story. He was 35 years sober, had lost everything, and got his TV break at age 40.
Because he was fiercely curious and teachable.
Yes. He pitched Bizarre Foods as a gross-out bug-eating show. That was the Trojan horse. He knew a commercial network wouldn't buy a show about cultural empathy.
They'd tell him to go to PBS.
Right. So he sold the spectacle to get on TV, but his actual goal was to highlight human commonalities. And he used brilliant business leverage, too.
Oh yeah, when renegotiating his contract instead of a pay bump, he demanded the network buy 10 episodes of a completely new show.
Which let him cash flow his own production company. Incredible leverage. And that exact same Trojan horse strategy is happening at Scott's Miracle-Gro, this 158-year-old lawn care company.
Yeah, their new CEO, Nate Baxter, is launching SMG 2.0.
Moving away from those all-in-one chemical bags for a perfectly manicured lawn and leaning into soil health, biologicals, and native grasses like fescue that require no water.
Because the next-gen consumer doesn't care about a perfect lawn. They just want a safe, natural space for their kids and pets.
They don't care if there's a dandelion. Scott's even sold off their cannabis business, Hawthorne, because of oversupply and bad regulations, just to focus entirely on this consumer wellness pivot.
It's all about meeting the consumer where they actually are.
Right. So Zimmern sold bugs to teach empathy, and Scott's is selling dirt to sell mental wellness.
How crucial is this Trojan horse marketing for legacy brands today?
I mean, it's the only way to survive when consumers are exhausted by traditional ads. Whether you're navigating a rising 10-year Treasury yield, investing in capacity-constrained AI, or fixing your lawn, the old rules don't apply. They really don't.
The winners in this new era, like Turnus, Zimmern, Baxter, and even the independent Fed voters, are those who question groupthink, embrace messy data, and reinvent themselves before the market forces them to.
That is such a powerful synthesis. We've talked today about billions of dollars being poured into AI to make us faster and more efficient. But as Scott's Miracle-Gro reminded us, human beings inherently crave natural physical spaces to unwind and disconnect.
Yeah, absolutely.
So here's a thought for you to take with you today. What if the ultimate, most profitable use case for all this new AI technology isn't actually about keeping us glued to our screens? What if it's about automating enough of our busy work to finally give us the free time to step away from those screens entirely and re-engage with the physical world?
Now that is a paradigm shift worth hoping for.
Definitely. Thank you so much for joining us on this deep dive today. Keep questioning the old rules, keep digging into the sources, and we will see you next time.